If you haven't heard by now, the stock market is in major trouble. Since early July, nearly all the major tech companies that have been driving the market for the last 3 years have entered correction territory. Investors are fleeing due to various significant issues. Google is down 13% from its peak, Amazon is down 16%, Intel is down 57%, and Nvidia is down 19%. There are plenty of people claiming that this is the start of a major crash and that the US economy has begun its plunge into a deep recession. And it's not all sensationalism either. We can all see that the damage goes far beyond these technology giants. This downturn feels more significant because there's a perfect storm brewing in the markets that many are trying to get ahead of and avoid. The root of the problem stems in the world of rates. In finance, interest rates act like gravity on everything. When rates are high, prices including those of homes, groceries, and stocks tends to stay grounded. When rates are low, prices start to rise. Now, various complex storylines are developing in places like Japan and the US as a result of massive interest rate variance, and it's causing massive downstream issues in the stock market and the job market. So, what is happening? Is it really all on fire, and should we worry? Well, to understand, we begin with a bit of history. You see, since the beginning of modern economics, various experts have tried to develop ways to predict recessions before they happen. One of those experts, Claudia Sam, discovered that by measuring momentum in employment data, you can accurately predict a US recession. I won't dive into the specifics because it's a bit long-winded and boring, but here's what you need to know. The SAM rule has signaled a recession 11 times since 1953, and 10 of those times the US did enter a recession. That gives it a 91% accuracy rate. Today, it's flashing red again. And it's not the only thing putting pressure on the markets. Another factor is causing underlying issues within many of our favorite stocks. To understand this, we need to revisit interest rates. Back in February 2022, the Federal Reserve in the US started raising rates rapidly to combat serious inflation resulting from the COVID-related money printing in previous years. Higher rates make borrowing money more expensive. This was true in almost every country except Japan. Japan didn't have an inflation problem. They were dealing with deflation for a long time, and their government kept rates near zero for years. Wall Street saw this as an opportunity, leading to the Japanese carry trade. Traders would convert their dollars into yen and borrow large amounts at low interest rates. They then convert that money back into US dollars to buy US treasuries with high yields and invest in popular stocks like Nvidia, Facebook, Amazon, and Apple. To amplify their gains, they often use leverage, borrowing even more money in both markets. This strategy worked well for a while until Japan saw a hint of inflation and the Bank of Japan raised rates by just 0.25%. This move disrupted the trade. Simultaneously, US rates began to drop as the Fed considered cuts, causing the whole system to unwind. Margin calls started in the US, and Japanese lenders demanded their money back too. This massive unwinding is hitting tech stocks especially hard. Some of the biggest Japanese banks are experiencing huge 10% intraday losses, triggering circuit breakers and halting trading to curb the panic. Not only is the employment situation in the US deteriorating, but these massive leveraged rate plays are wreaking havoc, adding fuel to an already dangerous fire and creating catalysts for a significant market downturn. And it's not just bearish YouTubers sounding the alarm. Billionaire investor Jeffrey Gundlach had been warning for months that the US is headed for a deep recession. He reiterated these concerns on CNBC last week, explaining why investors should be worried in the coming months in this groundbreaking interview. Take a listen to his concerning words.
With the Fed chair. So, Jeffrey, you've been pretty explicit as well in calling for a recession. Every time we've been speaking and having these conversations, the Fed chair today, as you alluded to earlier, said he thinks we're well positioned. He likes where we are. The chances of a hard landing, he said, quote, I think they're low. Has your own view changed?
No, I have the same view. I think when we look back at what, today, and it'll be history when we look back at it, a couple of years from now, I kind of believe that we will say that we were in a recession in September of 2024.
Interesting. Because, he still thinks that the economy, obviously, is doing pretty well. Yes, there are some spots of weakness, said the Fed chair, but overall is good. You take issue with that, too, based on what you've been hearing from CEOs about the consumer?
I think it has to do with a lot of anecdotal evidence and a lot of the if you just don't look at one data point like the establishment unemployment rate survey, there's a lot of things around that are not nearly as encouraging. I talked about the quits rate is way down. Even leisure and hospitality, the unemployment rate is rising. Unemployment claims are rising. The full-time employment is being supplemented by part-time employment. Some people are working a full-time job and a part-time job. They're counted as two jobs, but that's just one person who's trying to keep their head above the inflation waters. So I don't know. I just feel that I hear a lot of people anecdotally that talk about, I lost my job, I can't find a new one.
As you just heard Gundlach say, there are serious concerns regarding employment that points to an impending recession. Gundlach isn't the only billionaire investor sounding the alarm. Arguably, the world's most successful investor, Warren Buffett, is also showing signs of concern. While he hasn't made any definitive public statements, his actions suggest an alarming scenario. Recent reports indicate that Berkshire Hathaway sold 55% of their Apple holdings in the first 6 months of 2024, a very unusual move. Buffett is now sitting on a record $277 billion in cash, with nearly 1/3 of that raised in the last year alone. This chart, tweeted by Turin Fan, visually puts everything into perspective. The last bar on the right far exceeds anything Buffett has done in the past 33 years. While Buffett hasn't publicly commented on the economy, his actions speak louder than his words. Billionaire CEO Elon Musk also saw this tweet and agreed, stating that it's clear Buffett is expecting some sort of correction. Musk added that this cash buildup wouldn't be happening if there were truly no other opportunities besides treasury bills. On top of all this, various geopolitical risks are adding tension to the markets. The war in Ukraine is still raging, the Middle East is heating up in a way that we haven't seen in years, and it's an election year, which historically means more volatility and uneasiness. Put all of this into a kettle and you get quite an explosive mix. To make matters worse, history shows that problems often start overseas and then spread to US markets and the rest of the world. This seems to be happening right now with the Japanese carry trade. For example, during the Great Recession, issues surfaced in the subprime market long before Bear Stearns collapsed or the recession became evident. On August 9, 2007, French bank BNP Paribas froze 3 of its US funds, making the start of a chain of events leading to the biggest recession since the Great Depression. Imagine trying to withdraw cash from your retirement savings only to be told we can't do this because we don't know what some of these stocks are worth. Paribas funds were tied to subprime mortgages in the US, and this freeze was the first public acknowledgement that even the experts, even the banks themselves, couldn't figure out what these funds were built on. This uncertainty caused these Central European banks to step in, signaling to the rest of the finance world that the American housing boom could be a house of cards. 1 month later, the S&P 500 began its collapse, and 6 months later, Bear Stearns fell, triggering the chain reaction that essentially brought down nearly every major economy on Earth. Today, with Japanese banks experiencing their worst one-day collapse since 1983, many believe this Japanese implosion could be the Paribas of 2024. To put it all together, the summary begins with this. The S&P 500 gained over 56% since its local low in October 2023. Much of these gains were driven by the Magnificent Seven, including companies like Nvidia, whose gains were significantly boosted by the leverage trick known as the Japanese carry trade. In this strategy, investors borrowed cheap money in Japan and invested it in the US using excessive borrowing. While this greatly increases profits when things go well, it leads to rapid losses when the tide turns. In 2024, a bizarre interest rate environment emerged, with US rates collapsing and Japanese rates rising. This led to a mass liquidation of the carry trade, likely causing margin calls and forcing the leading tech sector to suffer a sudden downturn. Combine this with already bad employment data, an uncertain election, and massive risks in the Middle East, and you get what many are calling the beginning of the AI-led bubble bursting. There is growing concern that this rapid market collapse will eventually bleed out elsewhere, impacting banks and spreading all kinds of problems in the rest of the economy. As I make this video now, the S&P 500 is down 8% off its highs and the Nasdaq 100 is down about 14%. Just in 2023, we suffered a 35% drawdown in the Nasdaq 100, so this latest iteration isn't exactly record-breaking. There are still many days ahead to see how this plays out, but the reasons for today's massive panic aren't rooted in the present. They are rooted in what the picture is starting to look like in the near future. More importantly, the SAM indicator suggests that this is only the start of a potential downturn. Adding to this are Warren Buffett's recent actions, which indicate his cautious stance in the current market. Furthermore, the recent Japanese market behavior with its worst one-day collapse since 1983 is raising fears of a broader financial crisis. Global uncertainty and massive bubble-like valuations are also fueling the panic. These factors combined explain why everyone seems to be panicking about this somewhat small market correction. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it. And let me know what you're seeing in the comments below. Do you agree with Jeff that the US is headed into a deep recession, or is this yet another false alarm? If you want to help out the channel some more, don't forget to check out my Amazon affiliate link in the description. And while you're at it, you can also check out my brand new Substack, where I will be posting an article to go along with my video, a way of showcasing some of the more interesting technical details regarding this content.